G'day expats and welcome to another episode of Expat Chat, episode 68 today, and joined by the guru from the Gold Coast who looks after the Australian office and specialises in working with clients in the APAC and Americas region. G'day, James Ridley.
G'day, Brett. And for those listening, as always, join with my friend, colleague, mentor and business partner, Brett Evans, the Managing Director for the EMEA region. Brett, how is the sandpit treating you today?
Mate, it's awesome. It's 21 degrees on the way to work this morning, and
nice.
we almost put on ski jackets when we get in that sort of weather.
Mate, that's winter terror. That's winter temps. That's great.
Yeah, I'm sure I saw snow.
Sounds like it's similar to the Gold Coast, actually.
Yeah, it's good. It's good. The days are cooler, and we've got Halloween out of the way, which is a big event here.
Oh,
now it's the race to Christmas, mate, and we've obviously got the Abu Dhabi Formula One, which is another big event, and then after that we've got the FIFA World Cup, which personally I think Dubai and UAE is going to do better out of than Qatar, because everyone's staying in UAE.
Yeah, that's right. They are. Yeah.
The UAE spent 0 dirhams in building infrastructure and stuff. This place is going to be manic. So
it sounds like it'll be honestly probably party central, to be honest, while the World Cup's on. Especially probably in Dubai. But I wonder, speaking of the Formula One, I wonder if we're going to see a controversial race this year in Abu Dhabi like last year.
Max has got it sewn up, so I don't think it's going to be there. But you never know. There's always there's Mercedes versus Ferrari down the back, and then you got Alpine versus McLaren. So there's a lot of people who are still jostling for places. So
and our guy Daniel Ricciardo. I mean, he doesn't have a seat next year. What's going on? I thought he was going to be that secondary driver, reserve driver for Red Bull, but that hasn't come to fruition.
The rumours come back around again. Now I might be going across to Mercedes. So watch this space. I don't know.
Gosh, what a pivot if he lands that. Jesus.
I know.
But, mate, we're digressing. We
do that well. That's our speciality.
Yeah, we do. Yeah, I know. That's true. I'm going to let you do the legal disclaimer because I can't master that yet.
All the information that you're about to hear us espouse on a Friday morning for me, Friday afternoon for you, should be considered as beer o'clock. And you take this as educational, informational purposes only. Grab your beer, sit back, relax, but don't take this as personal advice. If you need to get advice, give us a yell.
That's it, mate. There is actually one craft beer in the fridge that I've left there. Maybe I should run and grab it, but no. But mate, today I wanted to kick in because I had a question, and it's come up a few times about different sort of from a non-residency perspective. So, when we're talking about expats being overseas, based somewhere in the world, how different income types or sources back in Australia are taxed, because depending on the income source, where it's coming from in Australia, the asset class, whether it's from the ATO's perspective or I suppose your own perspective, it's definitely taxed very differently at different tax rates. So I thought it'd be a good idea to deep dive a little bit into it. And I'm not sure whether this sort of topics come off because back in Australia, it's sort of just wound out the crucial tax time, 31st of October. And whether everyone's been doing their tax or whether they started receiving letters and notifications from the ATO saying, hey, it's tax time, get your tax return in. If you're not, or if you haven't lodged it by 31st of October, you need to now lodge it via an accountant or whatever it might be. So I think, I honestly think that's actually where the push for this topic has come from, driven by our listeners. So I thought, what a great opportunity to just hash it out with yourself, deep dive, workshop it a little bit. So let's jump into it. I mean, throwing it back over to you, I suppose layering it from a high level perspective, different income sources from the ATO's perspective, what would you say, Brad?
Man, let's start at the beginning. To me, people don't realise when they move overseas that when you are an Australian tax resident, your assets and your income are treated the same. Assessable income, capital gains tax with a bit of tax exemptions here and there thrown around for good measure. When you do jump on that plane and move overseas, then things get different. Your assets split and they either become taxable Australian property. And the best way to think of what is a taxable Australian property is a physical asset, a house, apartment, a block of land. So things you can kick. And then you have non-taxable Australian assets, which are digital assets, shares, ETFs, managed funds, crypto, LICs, REITs, and the jazz. So things that you can't actually physically touch are
That's
non-taxable.
right.
And when we get that asset split, essentially what happens is the treatment of those incomes split as well in terms of A, taxing, B, reporting, and C, how you treat it from from a personal income point of view. So, mate, let's run through the first one, which is taxable Australian property, which a lot of folks, on the call will have property back in Australia. How do they treat Australian sourced income from a taxable Australian property?
Absolutely. I mean, property is a terrific topic right now. I think it's on the tip of everyone's tongue back in Australia because interest rates going up, and they're like, well, what are we going to see, and what kind of pain are we going to see? And it's interesting to see some of the stats that are coming out. But when we talk about property, taxable Australian property, those physical assets, the rental income, the way it's taxed. So, best way to look at a hypothetical example, we've got an investment property, which was our former main residence. And, it's producing after all the tax deductions. So that's the interest expense, that's the maintenance, that's the council rates, maybe insurance, body corp fees, agent fees. It's still giving us $10,000 in income. So we would say that, okay, well, that property is positively geared. You've got $10,000 each financial year that you're having to pay tax on. Now, your tax rates as a non-resident on that income source start at 32.5% on the first net dollar. So, if you're looking at it cleanly, well, that's $3,250 on that $10,000. And when we look at those income tax rates, there's quite a big gap there in terms of the tiers. It's 0 to 120,000, 32.5%. And then the next tier tiers up to 37% and then 45%. So you don't have access to the tax-free threshold. You don't get access to the 19% tax rate tier. There's obviously the 32.5%, which you're paying, and then there's a 34 and so on and so forth. So you're missing out on a few tiers, plus you don't have access to the tax-free threshold. So it does mean you do pay a significant amount of tax, 1/3 to the ATO, when ordinarily you don't have to if you've structured your assets correctly. It depends on everyone's goals, your individual circumstances, of course, but you don't need to be paying that tax if you've got the right strategy in place. But when we look at taxable Australian property assets, TAP, those are the tax rates that we pay. And I guess there's no real stopping that, and it's purely because of how you've set up and structured those assets accordingly. Now, the other assets, which Brett briefly touched on, and I'm going to throw the ball back over to you now, Brett, is non-taxable Australian property. So how are these assets taxed or not taxed maybe?
Yeah, to me, the biggest difference at the outset is from a reporting requirement, from a taxing requirement. So when you receive income or dividends or those sort of things from non-taxable assets, essentially the way it works is there's three sort of tax tiers that you have to comply with. First one is if you've got cash in the bank, you should be notifying your bank that you're an overseas resident, and they'll withhold from you 10% as a non-resident withholding tax. So if you are getting $1,000 tax credit, income in interest from money sitting in the bank account, they'll withhold $100 and pay you the $900.
Yep.
Same thing works with dividends, but once again, the dividends will depend on your jurisdiction. So if you reside in a country with a double taxation with Australia, Singapore, UK, US, and everything else, then when the dividend gets paid to you, it's a 15% deduction and you get paid 85. If you reside in a country that doesn't have a DTA with Australia, Hong Kong, UAE, Saudi, Portugal, Greece, then they'll withhold 30% of that dividend payment or income payment and pay the net residual. Where it's completely different to property is with property, the tenant pays you the rent, and then you have to turn around and declare that to the ATO saying, Jay Bloggs gave me $1,000 a week, I've got these deductions, and then that's my net. Where it's different with non-taxable assets, shares, managed funds, ETFs, and those sort of things, is you don't have to turn around and give that money to the ATO because it's already been deducted on your behalf by either the share registry or the bank or whoever's paying you that dividend stream. Yep. So it's a bit backwards to the way property works, but the good thing about it is essentially it's your declaration being done on your behalf as opposed to your property. You have to declare to the ATO what that money is. Now, one thing we come across on I wouldn't say a daily basis, but certainly a weekly basis is the confusion regarding if your property is either negative or passively cash flowed, do you have to lodge a tax return? Because they're saying, well, I've got no tax to pay because, I'm not making a buck on it. And, we say to people, yes, you do. You still have to tell them, even if you're making an income loss. And that's the other thing too we need to say is people refer to as tax credits. They're not tax credits. They're income losses that accrue in the background.
It's like you've taken what's going on in my brain right now and you're speaking it to the to the masses. I hate it, to be honest. When listen, I've got nothing against accountants. I used to be an accountant, but I hate some of the terminology that some accountants use. They refer to losses, income losses, as tax credits. I had the exact scenario play out with a client recently where they're looking to vary their income taxes on their Australian wage income. And because of the miscommunication between the accountant and the client was saying tax credits, and the client obviously thought, no, they're just income losses. The variation wasn't lodged correctly with the ATO because they're not credits. They're just accumulated losses. Yep. Credits means that you've actually got $1 worth of a tax amount, such as a franking credit or income tax paid on your behalf, already preloaded in your income tax return. That is not the case. An income tax loss, or I suppose carry forward losses, they offset income first, and then obviously capital gains, that's a form of income, those sort of things, but they are not tax credits. It really grinds my gears when I hear they're referred to as credits, because they're not one for one.
Accumulated losses. Yeah.
Yep.
And that's also another good segue to talk about tax credits on the non-taxable asset side with dividends. So if you own BHP or Telstra or Woolworths shares, these companies may pay a dividend with an attaching franking credit attached to it. Now, the way franking credits work, and let's jump back to franking credits 101. Let's say, for example, BHP make $1 billion. So they've got $1 billion profit. They've got to turn around to the ATO and say, hey, Mr. ATO, we've made $1 billion this year. They will pay to the ATO 300 million of that 1 billion as company tax, 30%. And then they'll have 700 million left over to pass on to shareholders by way of a dividend. And then BHP will work out what their dividend payout ratio is, and then investors or shareholders will get the commensurate dividend. Now, because that $1 billion pool of money has already had tax paid on it once, the ATO can't turn around and tax you again on it because you've already paid tax on your behalf by BHP as part of that profit. So what happens is you get a 30% tax credit. Now, if you're a resident in Australia and your marginal tax rate was 40%, then you would pay 10% top-up tax.
That's right.
So 30% tax, paid for you, and then you pay the difference on top. As a non-resident, then you don't have that, so you have no Australian sourced income by way of employment. No. So in that case, it's either 15% for a resident of a country with a DTA, or 30% of a resident of a country without a DTA. So if you reside in, say, Singapore, for example, you've got a 15% tax liability as non-resident withholding tax, but you've got a 30% tax credit that offsets the non-resident withholding tax, and you essentially don't have any tax at all to pay on the Australian side with that dividend. Now, one thing I've got to point out, and this is another thing that I know grinds your gears, is some accountants out there will try and use the unused portion of the franking credit. You cannot use that. So if you've got a 30% franking credit and your non-resident withholding tax is 15%, half of that franking credit goes to extinguish that liability. The other half you lose. There's nothing you can do about it. Don't try and claim it back because you can't do it. If you're a non-resident of a country like the UAE, where I am, then in that case, it's a 30% non-resident withholding tax, 30% franking credit. They offset the two. Happy days.
That's right. Exactly right. And I mean, the offsetting side can't be done. And I mean, some accountants, because they're not familiar with the non-residency side, they do enter the wrong things into income tax returns. I remember coming across an expat a couple of years ago where they were receiving franking credit refunds. I was like, how the hell is that happening?
Yeah.
And I was like, how long have you been receiving franking credit refunds? Oh, 10 years. I'm like, oh, shit.
Yeah, Houston, we've got a problem.
And then, you're the one that has to give that bad news because that's literally completely against the legislation. So they obviously had to backfile and correct their tax situation there. But no, I mean, non-residents definitely should not be receiving franking credit refunds because naturally of how that income source, non-taxable Australian property, is treated when we're a non-resident. I mean, often it's a case where if the platforms or how we're investing and how we're structuring are automatically doing that withholding tax for us. So we're essentially paying tax as we go. We're on the PAYG system, you could almost say. We often might not have to declare that income, like as Brett said earlier, on our Australian tax return. It's often the case where we've done maybe the wrong thing or we've forgotten. We've forgotten to do that little administrative item where we're telling the banks we're non-residents. So, if we haven't done that, they're not going to know to withhold any tax at all. You might receive a funny letter 18 months later by the bank saying, hey, we know you're overseas. Where are you based and what's your tax identification number? So we can start applying that withholding tax. Funny story, actually. I mean, with the bank interest, if they brought in a rule back in 2018 where if we told the bank that we were overseas or a non-resident and we didn't actually give them a tax identification number or give them the correct details, they're actually legally required to not withhold 10%. They're actually required to hold 45%. So if you don't do the right thing by yourself, by telling the bank the correct details, they'll accidentally apply the wrong rate of tax. So rather than you paying 10, you're paying 45. You should get it back, but just set it up appropriately once you firmly set up in your new location. It's not that hard. It doesn't have to be that hard.
It's good housekeeping.
It's one of those. That's it. I mean, life administration, we all have to do it. And it's just those little things that help map to that situation that you're a non-resident. I know in our recent webinars, Brett, we had a lot of questions around the residency rules. And I guess we're in a bit of a holding pattern, as always. I suppose expats, they're always in a holding pattern, aren't they, into perpetuity?
Pretty much. And I think, we need to map to the current rules, the current intent. My gut tells me in the next 1 to 2 years. If it is a beast of a piece of legislation, and clearly Labor's not going to go off the cookie cutter approach that the Board of Taxation has recommended. Otherwise, they would have done it. So to me, they're going to revisit it. To me, they're going to put their own spin on it. They're going to make amendments where they see fit. But let's say, for example, they announce it in the May budget next year. Well, then they've got to draft legislation. That's got to go through the lower house, upper house. And we're not going to see the light of day until 1 July 2024. If they spend another 12 months working on the legislation, 1 July 2025.
That's right. You don't. I mean, we were talking about this the other day offline. How they've released that draft ruling recently, and obviously, that's right. So that's sort of a bit of a consolidation of different rulings in the past, and you don't release that for just any reason. I think it means it gives you a bit more time. But I guess when they announce the change in the residency rules, there's always a bit of a lazy way that they announce it through the budget because I guess no explanatory memorandum behind it, no explanatory bill. It's like refer to Board of Taxation report, but there are a lot of holes and gaps in that report. That's right. So it's. Yeah, I mean, it will get done, but I think we're actually probably, as you said, maybe 1, 2, maybe even 3 years away before it actually gets legislated firmly. So it is, as we said before, we've said at those seminars and webinars, it's probably the biggest piece of tax update that will impact expats probably in our lifetime. Remember, the last one was 1936.
Exactly, and then that's the biggest thing from our point of view is, it's always good to have a weathered eye on what's coming down the track. But at the end of the day, the rules apply are the rules that were set in 1936 and they apply today. So you always map to those rules, but with the flexibility to adapt to the new proposed rules, whatever they may be, shape or form down the track.
That's right. And I mean, I'm just going to drive us back to the main topic for today and talking about income sources. One thing that we always voice around superannuation, it being agnostic, regardless of your residency status. And whilst super doesn't technically fall into a category of taxable Australian property or non-taxable Australian property, I mean, it's its own separate beast, let's be honest, its own classification and a category. But if you're residing overseas as a non-resident and you're of the age where you're drawing out an account-based pension, that's treated the exact same way. So that would be a tax-free income stream that you're pulling out because you've met all the relevant requirements and it's a full account-based pension. So it's important to drill down on that because a lot of clients of mine, a lot of expats, they have plans to remain overseas and retire overseas. And I guess there's always a bit of a grey area of how super might be taxed, but it's agnostic. So it's treated the exact same way from a withdrawal perspective or drawdown perspective, I guess we could say.
Definitely. And I think that's an important point too, because then there's the other side of the equation that you need to be compliant with and understanding of is how that foreign jurisdiction that you reside in, where you're retiring to, treats that income as well too. some treated more favorably than the others. So from an ATA point of view, we could do a whole other episode on how different jurisdictions handle Australian super treaties. But, I think let's wrap it up there. I think we've given a pretty good summary on, when it comes to treatment of income, most importantly, if you do have taxable Australian property, report it. Even if you are accruing losses, you still need to report it. If you are in positive cash flow, it's not the end of the world. There are strategies you can use to reduce your tax rate. Reach out to us. We can run you through those. If you have non-taxable assets, digital assets, that's taxed at source as long as the account is set up correctly. I'm not going to go too much into detail about the problems we've seen in the past. We've talked about a fair bit. If you try and use a friend or relative's address in Australia for a brokerage account to try and sidestep compliance regulations, that will bite you in the backside. Eventually, but if you set up everything right, as you say, notify the banks, notify the account providers that all this is there, you got nothing to worry about.
That's right. And I mean, as we wrap up today's episode, I mean, it's hard when you first head overseas and you're new expat. You've only been overseas for a month or two, so you're in that state of flux still. You're probably sourcing your new villa, your apartment, or house, or wherever you're renting, sitting, going to rest your hat with the family. In that period of flux, then it makes sense that you can't update those details just yet. But once you're committed to, say, a 12-month lease, I think that's a pretty good trigger point that you're like, okay, we're here for 12 months. That's my trigger point to now go. Financial assets need to be updated, MyGov, ATO, Medicare, all those sort of things.
Yep, definitely. So, mate, I think we'll leave it there, and we'll see. And also, we just got a couple of reviews in over the last week, so thank you very much, guys. Keep them coming. I said we're not braggarts or egotistical, but it's just nice to see that people are listening apart from our parents.
That's it, guys. If you're obviously catching up with your other Aussie expat mates, feel free to shoot them a link, share our expat chat, because obviously we do this for you guys. We're just trying to give as much sort of education around the whole, I suppose, diaspora of being an Australian expat and acting as a bit of conduit as well.
Definitely. So, right, mate, I'll leave you to get on with your Friday. I'll get on with mine, and see you next week.
Sounds good, mate. See you soon.
Thanks, mate.
Cheers, Brad.